Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're going to take a quick look at the Procter & Gamble company, ticker PG. This is a stock that I held previously when I was really into dividends, and it's pretty high in the S&P 500, so worth taking a look, filling in the numbers, and seeing is it worth holding in a portfolio. Spoiler alert, it's a classic blue chip stock, so if you can get in at the right price, maybe, but I don't think right now is necessarily the right price based on the growth rate. So, to get started, earnings yield 4.16. So we'd expect $8.13 in EPS for what we're paying, and what we're actually getting out of them, $6.78 this year, $7.02 next year are expected. So $8.13 sounds like it's a solid 4 to 5 years away. I don't know why this stock trades at such a premium. If you look at the PE ratio, 23 to 25% consistently. So it does trade for a decent PE. Cash flows are good, growing, 19.66 above the average of 18.47. The dividend yield is pretty high, 2.34 on average, 2.15, and payout ratio a little high based off last year's EPS, closer to where we like to see it based off of this year's projected EPS. ROE looks super high, 29.49%, and it's because their debt is pretty heavy, 1.45 for the debt to equity. That's higher than the one that we look for. ROI 12%, ROA 12%. Returns are solid, debt's a little high. Margins, gross margin of 51% is really good. On average, 49.5. Net margins of 17.4, on average 17.8. So the net was down a little bit when the gross was up. So PE ratio of 24%, kind of where it typically trades, with a earnings growth rate of 3.54%. So our price to earnings growth is 6.77, which is very high. For the growth that you're getting in the earnings, it's not really worth that premium. So what I'm seeing here is mostly valued off that dividend. I think that's the main thing they have going for them. Revenues, very, very flat, not even 2% growth in the last 2 years or projected in the next 2 years. So 1% is what we're using for the thesis. Share count, they do buy back shares, 0.5% to 1%, so we'll stick 0.5% in there and see what that gives us. Cash flows just in line with revenues. Keep those cash flows growing. That'll bring them up to 19.7% in the next 5 years. Just about where they are now. Assets, super small growth, somewhere between 1 and 1.5%. I think 1% is definitely fair to use. Liabilities, they did pay them down over the course of the last 3 years, up a little bit in the last 2. So I would expect that to be relatively flat, maybe a bit more growth. We'll have to see what they have planned. The dividend growth is relatively strong here. Really strong in the last 3 years. We can take a look at the chart and see what's going on there. Super big jump from 21 to 22, but has slowed down. 2% is probably fair there. At some point, it'll go down to 1%, just like the revenues, but hopefully that's not in the next 5 years. Buying at today's price would give you a yield on cost of 2.6%. So I don't even think that that's a decent dividend to be paying for. I'd want at least 3.5%. So if we get in at the 52-week low, do we achieve that? No. 2.7. If we get in at our margin of safety, do we achieve that? 3%. So 140 is my target price for the stock. Is it going to reach that? I don't know. Well, that's what I feel is probably a more reasonable price than what it is trading for today. And the margins, usually I don't like to stick 0 in there. I like to do small growth. 0.1% per year is almost nothing. Actually, they did have a down year. Let's try and get them to 18% in the next 5 years. If I put 1% in there, then that brings them up to 18.25 in the next 5 years. And that did adjust things a little bit, but we're still coming up with an average return based on this thesis of 3.88%. And once you factor in the dividend, we're looking at 6.22%, which is not the 8% minimum that we would expect from the S&P. So for that reason, I'm not really considering this stock. Now I can go look at what the dividend is at and maybe give it a higher weight in my valuation. So if I give it a heavier weighting towards the dividend, then our fair value shifts a bit and you end up with market outperformance in the next 3 years with the dividend factored in. And we can take a quick look at the price chart and see how things are trending here. If there's any concerns, this is usually a decent place to see where all of the different valuations are trending. As almost always, balance sheet lagging way behind everything else. Then we have the dividend, which we saw that jump in 2021, and it's out way above everything else since then. Then we have cash flows, consistently below the fair value and share price. The actual fair value seems to move pretty well in line with the earnings. They're starting to diverge a little bit in the future, but at the moment they are very close together. It's just the balance sheet and the cash flows are probably dragging things down a little bit. But when I put a higher weighting towards the dividend, it does pull things up. And then the share price, just slightly above those two. And that's where it looks like it usually is, just at a bit of a premium consistently over the top of the earnings, at least since 2023. I mean, they were super close, but inverted in 21 and 22. So when I'm looking at this one, just like a lot of other blue chip stocks, it's not awful. The balance sheet isn't in the best of shape, and the growth is just minuscule. So essentially, you're buying it for the dividend, and in that case, you really just want a solid yield. So, like I said, I would want at least 3%. I mean, right now you're getting 4% out of bonds. So if you can get into this at a price 140 or below, it would not be an awful move. But getting into it at 160, 170, I just don't believe that you're going to be outperforming the market in any sort of way. You're probably going to have a relatively safe investment, but you're going to underperform the market by at least 2%. So that's what I'm seeing on this one. I want to thank you guys for watching. Please like and enjoy the video. Comment what other stocks we should take a look at. And subscribe so you can stay up to date with everything. And I'll catch you next time.